everybody, it's February 15th, 2018, and today's webinar focus is review of morning trade and scenarios for the afternoon trade. Give it over to you, Jim.
Thank you. What we're going to do this morning is for those that are already clients, we have an intensive that starts on the 26th of February. As soon as people sign up, part of the real advantage is that I'm sending out the morning report and the evening report, and I'm posting live chats throughout the day. Before I go and show you some of those from this morning, we had a special running for Valentine's Day. I just found out from Jen that the coupon doesn't actually expire until midnight tonight. Is that right, Jen?
Yes, we just did that so that in case there were time changes around the world and things like that, that we could accommodate for that.
So if you still come in and you still want to get in that special, the coupons don't expire till tonight, so you still have that opportunity. Before I start showing you some of the posts from this morning, one of the things that I want you to think about, a lot of times people come into the intensive or they're thinking about joining or, with anybody. What they want to know, so many times people say, well, are you going to tell me where to buy or sell? Well, if you're not going to do that, what good are you? Well, no, we don't. We don't tell you where to buy or sell. What we do is we try and teach you how to think about and how to reflect on what is going on in the marketplace. And I hope you'll see that as we go through the chat comments this morning. And, the actual thing is, I don't know exactly where the buy and where to put the buy and where to put the sell. All I'm trying to do is get my orders on so I'm in the ballpark, and I think the odds are in my favor. They're never going to be 100%. If the odds are 100%, there's not going to be an opportunity there. Talked about this many times. Talked to businessmen. Businessmen usually make decisions when they have about 60% information. If they had 100% information, the opportunity is still gone. So let's go on with this and let's talk about the tweets this morning. First, let's look at this morning's market so we get a feel of what has gone on. You see the market gapped higher this morning. It eventually broke down, traded below the overnight low and well into yesterday's lower distribution. Now, last night's report commented on the poor structure from yesterday's rally. And I thought there was a good chance that we would retrace at least a portion of yesterday's structure or profile simply because of the poor structure. And there's an anomaly of poor structure, right there. I mean, it just wasn't very healthy. Very thin, very strung out, another anomaly. Now we didn't get all the way down there, but we got into that portion of the structure. Now I want to go and I want to talk about the posts that we put up this morning. And this is, I think you'll find these of meaning. Shortly after the market opened, and if there's spelling or grammatical mistakes in here, please forgive me. I use Dragon, which is a dictation thing that I can just speak into my microphone and it puts it up on the chat comment. I don't have a lot of time, and I don't want to waste a lot of time meticulously making sure the sentence is correct and all that. I want to get the post out to people. So the first post, and you can see that went out at 9:38 this morning, 8 minutes after the open. Natural sell-off when overnight inventory was as long as it was. Logical bounce came from just above half back overnight. Half back overnight should have been day time frame reference early in the session. Let's go look at that. Okay, there was two things here. There was the overnight half back, the white line, and the very prominent point of control from overnight. The first break was just short of the half back, and it was, just around the prominent point of control. So I was really looking at these in combination. So you'll see the A period, the market broke down to that level in A period. Okay, let's go back to the slides. It'll be a little awkward as we go back and forth, but I think it'll be meaningful. Oops, what'd I do? Okay, next post, which was just a couple minutes later, you will notice that the actual rally came from a couple of ticks above half back, which was the prominent POC. The more prominent an overnight POC is, the greater the likelihood that it will get revisited during the day time frame trading. Now, is that 100%? Absolutely not. But it happens quite often. So what you want to be thinking about, are we close enough to it to logically reach that very prominent point of control? And you will be surprised how many times the market will find its way back to that level before the day is over. Okay, the next poster went out at 9:42, just a few minutes later. When volatility is high and you're doing short-term trades, you need to have resting orders in the market. Waiting to see if the market is any good is often too late. I know that's a little scary to some people, but when the market was this morning coming down towards the half back area, one of the things I suggest, half back is, it's usually a pretty decent reference. What I would suggest, you put your order in a couple of ticks, not exactly at half back, but a couple of ticks above half back, if you want to get filled. When it goes there, it's amazing sometimes how quickly it will bounce from there. And by the time you click and get an order in, it's not uncommon to miss it. It's scary to do that. You have to have confidence and you have to be able to know that you can exit very quickly. But it's a thought. Next post. Again, now we're not even 10 minutes into the market and there's all these posts out there this morning. That's unusual. The second time down to the area that includes overnight POC and half back is not expected to be as reliable. One of the things I talk about is a semi-permeable membrane. This doesn't quite meet it, but it's like, every time you punch on something, it gets weaker. So the market goes down to the overnight point of control. It rallies, and then let's go back and take a look at what happened in there. There's A period. There's B period. Now, B period comes down. It's the second time down. B period takes out the point of control. It takes out the overnight low, and then it bounces from the overnight low. Okay, now we've been down there. It's the second time down. It wasn't as reliable. Let's go back to the posts. This is 10:17. It's a little earlier. Earlier, we posted that the second time down to the overnight POC and half back, there less confidence in those references. We now have a poor low at that same level. If this were longer term money on the sell side, we wouldn't hesitate at overnight POC and half back. Very important observation. As a trader, you need to know who you are competing against. Are you competing against other traders that are probably going to be more volatile and more fickle? Or are you competing against longer term traders? Longer term doesn't have to be the longest of time frames, but it would be more short-term traders, these are traders that have maybe funds up to $1 billion and highly leveraged. When they come into a market, they're much more aggressive, and it's unlikely that the market's going to stop exactly at half back or exactly at some reference. When that happens, the chances are pretty good that what you're looking at is competing against other very short-term time frame traders. Okay, I'll read it again. Earlier we posted the second time down to the overnight POC and half back, there was less confidence in those references. We now have a poor low at the same level. If this were longer term money on the sell side, we wouldn't hesitate overnight POC and half back. However, since it's short term money, taking out this reference is just as likely to bring in short liquidation and selling. So that means, if you get back down there and all of a sudden the short term traders see that's not level going to hold, well, they have a tendency to pile on pretty quick and take the market lower. Let's go back and let's see what I can put next. This is 10 minutes later. No downside follow through. Time change coming up in 4 minutes. Now we're watching to see if you get any additional price acceptance below the overnight half back. Okay, back to the market. Now remember, now we're going to take A period, B period. Now you got C period. You get more extension. So C period, the market's been open, better than an hour. You get more acceptance down here. A period, you got a bounce. B period, weakened it. C period goes back up. Now when you come down through C period, you get some really heavy duty liquidation. Look at this C period, D period, and then you get a bounce in D period. Get a really good bounce way back up here. Let's go back and see the next slide. Okay, I'm going to leave it like this. It's not full size. Can you see it all right, Jen? Jen, you there?
Yes, I can see it, but I think some other people might have trouble if they don't have large monitors or screens.
Okay. It just, I'm sorry.
That's okay, just scroll. Oops. If you can put it in the presentation mode.
Okay, what am I doing?
If you go down and you see, okay, you can say from current slide, Jim. Yeah, right there. Click right there.
Okay.
There you go.
Then we write 2696.75, which is Tuesday settle, is the next lower reference. If there is anything meaningful here, you will want to see acceptance below yesterday's high. Trading to and through with acceptance below unchanged and increasing volume. Unchanged at 2696.75 is just above yesterday's value area. For high odds of downside continuation, the market needs to get back into yesterday's value area and show additional downside confidence. If that doesn't occur, then the chances are that we've seen liquidation from overnight inventory without additional selling. Now here's the important one. This goes back at 1054. Some of the most misleading short-term trading situations occur when there is a liquidation of overnight inventory with no additional follow-through. As we observe this market, we want to observe if there's additional selling now that overnight inventory is better balanced. Let's go back to the market. Okay, what I was saying in there, and I've said this many times, where people get tripped up. Overnight inventory last night was long. When you have long inventory and you get liquidation, means you're going to have, as we did today, you're going to have some pretty fierce price movement. Remember, on short covering how fierce that price movement can be, because people are just saying, get me out at any price. The same thing happens with liquidation. So you see the the C period, D period, but that liquidation is just fierce. People are panicked. They got long overnight, and you can see we were tremendously long overnight. We also gapped higher. Now, what I was saying is, all right, if there's anything to the downside, you have to find acceptance back within yesterday's value area. If, as the day goes on, you're not getting value that overlaps yesterday's value area, then there's a good chance that a short-term rally to the upside, in this case, is going to follow, because your value will be higher. So what you saw was liquidation inventory. And if you are basically a price follower and you don't understand what was going on, that was liquidation, it was from overnight inventory, and it wasn't associated with more serious selling. To have a more potent combination on the downside, you're going to need the liquidation, but the liquidation is going to have to be joined by short-term seller, at least short-term sellers. And by short-term sellers, I'm not talking about day time frame. I'm talking about the short-term sellers that are beyond the day time frame, but they have huge pools of capital, highly leveraged, and they can trade. They weren't there this morning. So it is so easy to get misled and get scared, of going on the long side, because you're watching this tremendous price break to the downside. It wasn't there. It's all we were looking at today, and you see where the market is now. We're well back up into the overnight range. So all you saw was the liquidation of overnight inventory. And you see here, some of the most misleading short-term trading situations occur when there's a liquidation of overnight inventory with no additional follow-through. As we observe this market, we want to observe if there's additional selling now that the overnight inventory is better balanced. Okay, that is crucial. Now, it may sound easy as we're here going after the fact, and you're not involved. It's not your trade. All those juices aren't flowing, and emotional levels aren't high. But when you're in the really what's going on, you have to have some idea of what you're looking for. If you don't have some idea of what you're looking for, you're going to be unable to act. Now, what we're trying to do with posting these comments is help you learn and build the habits to appreciate what is actually going on in the marketplace. Now, I'm not always right. I put in last night's report that, yesterday was an embarrassing day for me. I came in short yesterday morning. I covered prior to the opening in the NYSE, made a lot of money, and was overconfident. And I didn't read yesterday's market well. I didn't go back and see that, the day before was an inside day, and we had a 2-day balance, and we got above that 2-day balance. Okay, so I'm not always right. And so I have to learn. I have to go back and I have to learn too. But what we put in a report last night, I covered the mistake. If we're really going to be able to give you an understanding of what trading is really about, you have to see the mistakes as well as the successes. Now, the 2 days before yesterday, I was on. Today, I'm on. But it doesn't always happen that way for you. It doesn't always happen that way for me. But what we're trying to do is use that to be a mentor in your backyard as close as we can get. Okay, more commentary. This says the distribution low is the next downside reference. That was the upper distribution low. Next post, 11:17. It appears that what we saw was liquidation of very long overnight inventory without the more potent combination of liquidation of overnight inventory and additional selling by either short-term traders or longer-term interest. You want to continue to monitor potential to get the unchanged value. Next, you should notice that we have been one time framing lower since the first period. High. Continuation of one time frame selling would suggest additional selling. Let's go back to the market for a minute. Okay, you're coming down, and now D period comes back up. No stop, no cessation of one time frame selling, and then E takes out D period and moves back to the upside. Okay, so that's pretty much covers early this morning. I mean, it's now what, 10:30, 12:30, just about 12:30 in New York. It's only 10:22 out here where I am. But so we talked about the morning, and the morning was just a tremendous trading opportunities in there, but you had to understand and appreciate what was going on. Now, when we talk about, what's in store for the afternoon, from what I see so far, let's talk about nuances. If you notice, the B period high was a single tick below the opening. Okay, I noticed that earlier. I didn't put a lot of, I let it go because I thought there was liquidation, but it factored in immediately that, it wasn't high selling. If you had really new money selling, it's unlikely you're going to come from one tick below the opening this morning. That's a very mechanical reference. Now, so getting back up, it's not impossible to get back up there. Right now, value is clearly higher at a very, very wild morning. Now the market comes back up, but value is higher, and more than likely, what we're going to do is balance this afternoon. But here's what you're doing. You're now looking from D period, the D period low. We are one time framing higher now. D period, E period, F period. You look in the lower right-hand corner. It's 10:23 my time. You have 7 minutes or 6 minutes now until the time changes. What you want to monitor for this afternoon, you want to see if it gets wider in here, point of control, or if the market, after correcting the too much long and then getting too short on the break, now you want to see if we continue to one time frame higher, or did we get this short covering rally because the market got too short on the break and then begin to work lower. And you don't have a lot to go on. More than likely, I think we balance. But here's the key reference. There is the daytime frame half back, and that is at 2703. So if there's anything on the downside, you've got to get back below today's half back. If you continue to one time frame higher, you're probably going to go after this morning high. And keep in mind, I'm not enamored with the B period high. Right now, the market for the last hour, we're going to change time periods in 5 minutes. So for the last hour, we're moving sideways. So the market has found some short-term balance in here. So the big question for this afternoon, do we one time frame more from here, or do we go back down below half back? Right now, because we have a very substantial excess on the bottom, we had aggressive move to the upside. The only thing that I don't like about the odds of going higher this afternoon, and we have a possibility for another break, look at the E period low. The E period low was a single tick above yesterday's high. It's a very mechanical low. And that's weak money that buys it exactly one tick above yesterday's high. Now you've got that, and you've also got what I consider to be a very questionable B period high. Now, part of the thing that we talk about when we mentor people through the trading program is a term called chunking. A lot of you have heard me use that term. Chunking is a psychological term for, be able to look at information. What I'm talking about is, it's the same. The example I use is backing your car out of the garage. The first time it takes you forever to back it out. As you've done it for a couple of weeks, now it's a whiz going in and out. You do it almost automatically. What I want traders that are in our program to do is learn to chunk. I want them to automatically see that this E period low is a questionable low. At the same time, I want them to automatically see that the B period high is questionable because it's a single print below the opening. I want them to understand where unchained or where the half back is. And that, we've rallied from here and we're going to change time. Are we going to widen out? Or are we going to change and start one time framing lower again? Those things there's so many things that a lot of times I don't do it anymore, but I used to. Sometimes I get frustrated with the market or not enough volatility. I can go over and look at another market and I could understand that market very quickly because I was chunking what was there. I could see the same kind of information. I mean, I've been going on the long term, but I was pretty good to go over and look at the very short term. All right, let me say at this point in time, let me open it up for a few questions.
Okay. Didn't Jim find it hard to participate in the morning sell-off given that B period was one tick below the open and C period selling off from half back? Why weren't those weak sell-off points in Jim's commentary of the sell-off?
That's an excellent question. They were in my mind, but what overrode that, I definitely saw them, but what overrode that, at least the B period high, was that the overnight inventory was excessively long, and I thought yesterday's structure was very weak, and I thought it needed to be tested. Now, when the market broke, that B period high being one tick below the open, that factored into what I wanted to do on the break. When I saw the market forming this morning, I had bought some 2,700 puts. And as the market was breaking, instead of waiting around to see what might happen, I had orders in to sell those puts. So I wasn't looking at a particular price. I just I put a level thinking that you might get more liquidation of the overnight inventory, and at that point in time, I would just take them off no matter what happened. Yes, I saw it, but I was weighing other things, and there was the very heavy. I mean, when you take a look at the overnight inventory, there was yesterday's settle. Early on, we traded a little bit lower, but then the market traded high all night long. I mean, tremendous amount. And then when the news came, the PPI came out this morning, the market broke a little bit, traded all the way back up to here. And so there was never any chance to get any balance to that overnight inventory. So that was a factor. And that's one of the things that, how do you weigh this information? And that's what I was looking for. I mean, that's an excellent question, but it was just part of the equation, being the exceptionally long overnight inventory was part of it. The way the market came down to half back and bounced and came back down again and bounced told me that I didn't have new money in there. I had more short-term money, and the chances were better that short-term money was just getting the market even longer. A great question. Thank you.
Do you consider today is options expiration for the SPX in your trading at all?
I probably should, but I didn't. I probably should, because sometimes that can be powerful. But it's got anymore. We have Friday expiration, we have Wednesday expiration, we have today's. It gets overwhelming to me. The expiration, for some reason, that I have found most affecting the market is Friday's expiration, and along with month end. But I don't look at all of them. But I should be looking, but I wasn't. Okay. Other questions?
Yesterday you were looking at bonds, ZBH8. What were you looking for? How does it look today? Inside day, upper distribution so far.
Okay, the comment I made when I put the report out last night is that I put too much emphasis on bonds. Now, what had happened, what got me messed up yesterday was when the market was made its big break, the big monthly break. It was a Thursday. I think it was a Thursday night before it went down 600 points that Friday. I was watching the bond market, and I saw the bond market. I thought the bond market was going to break, and it broke in the after-hours session. When it broke in the after-hours session, I got short, and that was a big down day. So the bonds signaled to me that we were probably going to get a break in the market because it looked like the world was coming back to pay attention to inflation and interest rates. And there was another time the bonds broke and helped me. Well, typical trader, instead of just looking at the S&P market yesterday, I had it in my mind that bonds were weak. They were hitting new lows yesterday, and I got it locked me up. It gave me cognitive dissonance, which is, as you know well, the downfall many times of a trader. And I got that cognitive dissonance from bonds, and and it took me a long time to realize the market didn't care yesterday. The market, I believe, was terribly short. And when the market broke, when the S&Ps broke, following the release of CPI yesterday morning, market broke well below the previous day's high, got very short, and by the time we opened, we were well back into the previous day's range. Well, I think the market was already short from what had happened over the last month or a few weeks, but it was also got even shorter on yesterday's break. And the market had a great short covering rally. But the bonds were another thing that contributed to my failure yesterday. But right now, the market's not paying any attention to them. Wasn't paying attention yesterday, not paying attention now, I don't think. Other questions?
If the profile continues to get wider and we get a break below half back, would you be looking to fade since we are expecting balance?
A pretty good question. Depends on how fat it gets up here. Depends on how fat. Here's the point of control right now, and a point of control is now valid because we're rotational. We went down, we came back up. We are still one time framing higher, so I have my eye on that. But it's certainly a potential if it breaks this afternoon, but I doubt it because it's getting fat up here. I don't know if I expect an awful lot. The only thing that's in my mind still is that the E period low is a single tick above yesterday's high, and I am looking at that. Other questions?
At what point would you make a bet on a long or short for the afternoon, or would you just sit on your hands?
I'll probably wait. And see if something opportunistic comes along. And it's one of the things I've found that, and a lot of people have heard me say this. If you go looking for a trade, more than likely you will find one. And more than likely it's going to be wrong. You let the trade come to you. Yeah, a lot of people say, I don't know what the heck you're talking about. It makes no sense for me. I'm looking for a trade. Well, what makes it all of a sudden, it just appears to me. If I have a good understanding, I know that the E period low is questionable. I know that the B period high is questionable. I know we're right in the middle. I know we've had a lot of volatility this morning. I don't see anything right now. So I will sit there and wait and see if something develops. I'm very opportunistic that way. If I go looking for a trade, more than likely I can find one on the upside or the downside, and more than likely it will be wrong. I mean, that's a really tough thing to understand, and you only understand it. You only understand it when it's happened to you a couple times. It's the same thing as when you take a golf lesson. You know, when the shot is right, you hear the sound. It's got a different sound to it. It feels better. And you know that was the right shot. And, you know, it's when you do something like that in the skill area, you just know that you figured it out. One of the things that was really interesting to me was I took a few I'm not a golfer, but I took some lessons a few years ago from a guy that had been blind. In fact, I'm sorry, he was still blind. That sounds he'd been a golfer, he went blind. He still gave good lessons because he could tell from the sound exactly what you were doing. And it was just amazing to me. But you know, that when you find a trade come to you now and then, you start to understand what it looks like, what it feels like. Additional questions?
Can Jim quickly recap why he considered yesterday's structure weak?
Yeah, it was one distribution, two distributions, an anomaly that wasn't revisited. Just anomalies, just something that sticks out from the side of the profile. Another distribution, a final distribution, you know, and a profile, another anomaly. When you look at yesterday's volume, it was up over the previous day, but it certainly wasn't volume commensurate with the distance that was covered yesterday. Now, we're always looking at volume. Let me go take a look here. When the market broke this morning, I immediately went to look at volume, and this is I think this is the 11:30. Is this what time? Is this Eastern time?
It's Eastern time.
Okay, so it's been 9:30 my time, about the time the market broke. When the market broke, we didn't get any huge increase in volume. And if there was really selling there, we would have seen a substantial increase in volume. Yesterday's total volume was 3,000,008. That's after they get the runoff. Okay, 3,000,008. I mean, that's heavy volume, but it's certainly not heavy volume for a market that covered. How many handles was yesterday? The low was 2642 to 2701. You know, 60 handles, and you got 3.8. That's short-term trading money. That is not longer-term money in the market. When this market broke, you know, did it break a lot? Yeah, it got down to 11-12% area, and volatility spiked. I still didn't see any signs that we really had any long-term money in that market. I think we've got a lot of trading money in here, but I don't think we've got long-term money. Other questions?
Do the weak references that you talk about surrounding the day time frame apply the same for all markets?
Yes. I mean, you know, all these concepts are applicable to basically any market that's financial in nature. You know, for the NASDAQ, you trade the NASDAQ, it's not as exacting because it's a thinner market, more volatility. So the references won't be exacting. The E-mini, which I love the E-mini, because the references are more exacting. But you know, you got to understand the nature of the market you're trading. Crude oil's a little thinner, so that you know they won't be quite as exacting. But there's certainly what you're looking for is the behavior. When you see that the market's being sold at a very visible reference, that's an indication that you're looking at, you know, pretty short-term money. Long-term money, and I've said this over and over again, long-term money, when they're trading, they have a lot of size to do. They are not waiting. They are not waiting for exact numbers. That's crazy, because what they're looking for good execution, and that execution, normally their size is fed into the market over time, and they're not trying to kill the market. For those that were around, was it last Friday that the market made a 1,000-point recovery from the low to the high? One of the things that I wrote just before that market rallied was this was not institutional selling. I said there was too much elongation, and and that's not what institutions do. They're not out to destroy the market. So that's what set that market up for the huge recovery. It was all short-term emotional money, so afraid that they're going to miss something in the market, that they just kept piling on and selling and selling and selling. Institutions don't do that. They have more maturity. They sit back. They're more patient, and they know they've got too much size. So, you're always looking at the behavior and understanding, who am I competing against? As traders, we're opportunists. We're looking for an opportunity. We want to take advantage of somebody. What we don't want is being taken advantage of ourselves. So, as an opportunist, you've got to be able to read the market. You've got to understand those that you are competing against. What are they doing? Who are you competing against? Are you competing against short-term or long-term traders? Or long-term investment? Makes all the difference in the world. Okay, a couple more questions.
At what stage, well, I just want to interject. There was another person who said that they wish that you discuss market profile with individual stocks. I just wanted to point out again and drive that point home that the concepts that you teach can be applied to, individual stocks, provided you understand your stock that you trade, the nuances of it and everything else. But you can apply the same concepts to any.
And I've traded individual stocks for years, and one of the reasons I changed is because we started doing these educational programs, and there's so many people that trade the S&Ps or something related to the S&Ps. So that's why I trade this, because it's and why I trade it and why I teach it, because it's the best way that I have to introduce the long-term concepts. And the short, for trading, but also long-term. But I used the profile. I used the same thing for trading real estate back in Illinois. It was very successful. You didn't have the same volume, but I was in an area north of Chicago, and I plotted the sales and the price ranges on a profile chart, and it was very helpful. Okay, a couple more questions.
At what stage do we know yesterday's liquidation is over and there is no follow through, and the odds are we can go long?
Just because the liquidation is over doesn't mean you can go long. Okay, that's not a necessary. Now today it did, but part of it, part of the thing people are waiting for, they want that exactness before they make a decision, and that is usually a killer. As I say, exactness kills. Okay. This morning, first of all, you're looking to say, how much confidence was in this market this morning? When we went down and bounced a couple times from, the overnight POC and half back, and then finally broke it in C period, how much confidence do you think is there? It's not huge confidence. If you had serious money selling, you're not going to go to half back. You're not going to go to a very visual level and bounce. It's just not what's going to happen. And, it's just more serious money. But when it goes from this, it tells you it's trading money. So when it broke this morning, I said it's probably trading money. And then you say, okay, you liquidate, you got a lot of liquidation. But when you finally took out yesterday's overnight low, that's a chance that, you may have blown them all out of the water. And that's exactly what happened, right? D period, it took out a few of these stops, and then the market came back above the overnight range and started to work its way higher. Now, did you know exactly that's it? No, you didn't. But that's what makes, if you know exactly, there'd be no opportunities. But I had a pretty good idea what's going on. That's why I say I put orders in leading the market as it was breaking in order to cover, cover my trade. But those are the assessments that you make. And as I say so many times, trying to be exactness and having too much fear that, oh, what if I'm wrong? What if, oh, look at that price. What if it really goes lower? Well, guess what? Sometimes you're going to be wrong. And that is part of trading. But part of the trading too is learning to be able to make a decision when you have about 60% information. And that's what we're trying to do is in all these posts, trying to give you more and more idea of how do you read and interpret the market. Okay, how about two more questions?
Well, this is a comment and a question that goes along with what you were talking about. I always look for exactness, how to get away from that habit.
I don't have an exact answer for that, but you try and think in terms of odds. Did we post that probability thing on Twitter yet? Jen?
Yes?
Did we post the probability article?
Probability article. I don't believe so. No, we did not.
Okay. We've got it. We got an article we're going to put in my blog post on Twitter sometime today. But it talks about the probabilities. But you need to think in terms of probability. That's why I went through, when I look and I don't have a lot of confidence in the B period high, that helps me think about realistic odds of going substantially further. When it kept hesitating at the overnight prominent point of control and half back, that told me that I didn't have, really long-term selling, more than likely. So that figured into the fact if I get a break here, there's a pretty good chance that it comes back. So those things all figure in. The fact that the E period is one tick above yesterday's high, that figures into what I'm looking at the possibilities to the downside as well as the upside. So, and then, not enough information is developed yet, but you have to be able to look and take in a lot of information. Now, what's going to happen? The first time you learn to chunk, as I'm talking about, to take in this information, it will probably confuse you even more because you get too much information. Once you learn to gather the information, then the next thing is, prioritizing the information. Excellent. I think it was an excellent first question. How could I take the trade this morning when the B period high was questionable? And I know where that question came from. Okay, I'm guessing that's something I taught. And when we look at this and say, well, but you showed me this, Joe. Well, it was one data point. Other data points, plus having, understanding that the overnight inventory was exceptionally long, they also were part of the equation. So I went ahead with the short, but that piece up there, the B period high, also, kind of helped me factor in that I wasn't staying around for a long time. So it's not easy. It's not easy to make that transition from being, exact. But a lot of people want to know where I get in when I get out. A lot of times I don't know. When I want to get in, I hit market. And when I want to get out, a lot of times I hit market. But today I used limit orders to get me out as the market was falling. So
I just wanted to add to that some other things that you can do to try to get away from that exactness habit is, document and journalize your trades, and then at the end of the day, go back see on the market profile chart where did you enter and where did you exit and things of that nature. And I think that may be quite revealing to you as well.
Yeah. Understanding what you're doing is a starting point, but it sounds like you already understand it. So, if you understand it, then you just have to start working on how to get away from it. I don't have any exact answer, for you. I'm not sure anybody does. But once, it's like somebody that goes through some kind of recovery program. Understand the problem first, then go to work on it. I always chuckle years ago. A lot of you probably aren't old enough to have watched the old Bob Newhart show. He was a psychologist out in Maine or New Hampshire someplace, and people come in. And they say they have a problem. He said, "Well, don't do that anymore." It was a riot of a program. It doesn't work that way, but I mean, it's the logical thing. Work on not doing it. Okay, other things.
Are there any key times, specific times that Jim trades or avoids?
No. A lot of people say, "Oh, they tell you not to trade at noon, etc." I just, if the trade is there, I'll do the trade. If the market's quiet and not there, then I don't worry about it. But I know a lot of people say, "Oh, they're locked into certain times," um, and it's not something I do. I mean, I generally, tell. Let's say for example, we open in the previous day's range, the middle of the previous day's range. Well, more than likely, I'm not going to trade that first hour or half hour. I'm going to let the market go back and forth and chop around. Get rid of the chop before I take a look at the market. But that changes all the time. But if the opportunity is there, I'll take it, as well as being in the market overnight. Okay, let's take the last question.
When you use options, how do you decide on the strike price?
Well, part of it's volatility. When the volatility was low, I was probably only one strike price out of the money. When the volatility is as high as it been, it was amazing. The other night, I bought some 26. I think they were 26.10 puts for 9. They had to be probably six strikes price or 5 strike prices out of the money. The market broke and the volatility was so high. They went out at 18. I got out at 18. So I'm looking at the volatility and how much risk I want to take. But the more volatility, the more likely I am to be further out of the money because of the volatility. Okay, let me say thank you very much. Remember that the coupon code doesn't expire until midnight tonight. If you haven't signed up to join us, we'd really love to have you. And you saw an idea of what I do on the post. That's just a way to kind of, be as close to mentoring you as I can be. And understand, I'm not always right.
Jim, could you go back to the PowerPoint slides and put our contact information up there?
I most certainly can.
Thank you.
Is this what I want?
Yeah, that or the slide before it as well, just so people can see like what the program includes. And if any of you have any questions at all, please feel free to call me or to email me. The tentative schedule of all the webinars for course 1 has been posted. If you go to the courses and you go to the view detail for course 1, you can click on a link in there that has the whole schedule already up there if you're curious. And we have over 60 hours of webinars scheduled just for course 1 alone. So if anybody has any additional questions,
Jennifer, I'm sorry.
Or anything.
Jennifer, before we go, would you take people to the dashboard and show them how they get to the morning commentary?
Sure.
Just show them how simple it is and the other stuff from the dashboard.
Sure. 1 second here. Let me.
It's not fair for me to catch her off guard like that. but it's so much fun. See how quick she is.
Can you see my screen? Are you able to see my screen?
Well, I gotta minimize this first.
I thought I was showing my screen.
Yes, I see your screen.
Okay, just want to make sure. Okay, so the daily reports are over here, just so everybody knows. The live commentary that you saw on the slides today was taken from here. And I'll just scroll through so you guys can see. It was just literally copy pasted, so if there's any spelling errors, they were included there on the slide so that you know it's authentic. But yeah, here's where all of the live commentary is, and we archive it as well for reference, people's reference. So all of that is located here. And with regards to the reports, Just to give you guys a sneak peek of last night's evening report, I can scroll through this, and this is where Jim was describing his embarrassing moments, so that you guys can have a good learning experience from that.
Yeah, my point was, you can read it. It says, this is about as embarrassing as it gets. Prior to today, I've been almost perfectly in touch with the market, going home short both of the last 2 nights and being quickly rewarded the following morning. I was rewarded again today prior to the market opening as I closed out my position in the electronic session, blah, blah, blah. If these sessions are to be of any value to you, it is important that I fully reveal my failures. Hopefully the sharing of my failures will be a significant part of your learning experience. And I do believe that. So many times traders think that, oh, somebody's got all the answers. And they don't. Nobody's got all the answers. And to think they do, can be very difficult. And if you think you're the only one that makes a mistake, you're not. You've got a lot of friends out there. I make mistakes. I make emotional mistakes. I make psychological mistakes. I misread the market. It happens all the time. And what you're trying to do is you're trying to get to the point where, it gets less and less and less as time goes on. Jennifer, thank you very much.
Oh, yep. And here's also, just to let people know, somebody asked, is the commentary emailed or is it just posted in the dashboard? It's posted in the dashboard, and then also you have the option to sign up to Jim's private Twitter to get the comments, the live commentary comments. But just to let you know, with regards to that, Twitter has a 280 character limit capacity. So if Jim's comments are longer than 280 characters, they get cut off, and you would have to go log into the live commentary to see the full comment.
But once it goes onto the machine, if you have Twitter, you get a bing, and so you know immediately that there's something to look for.
Mm-hmm. Also, for the morning report, in case anybody wants to peruse this and get an idea of Jim's morning report, because it's kind of a continuation from last evening's. Here it is.
Here, let me read it just for a second. Overnight inventory is 100% long as of 8:31 Eastern. The odds favor a counter auction or correction to overnight inventory. If there is no correction to overnight inventory, then it is long. If there's no correction to overnight inventory when there's long, that is an indication of strength, at least to begin the day. Again, a lot of people know that, but it was just, and I do it every morning. The client gets you prepared mentally as the market opens.
Mm-hmm. Okay, and let me, scroll there. There's the end of the report. Somebody was asking, because of the latency involved with Twitter text cutoff, they're asking if it's possible to do it via Dragon. Well, Jim basically writes his comments via Dragon and then just hits publish, and that way it's as quick as it can be. So we have not considered just doing a room where he would just be on a microphone when he wants to be or something like that. I think that might be distracting for him because he's often trading while he's doing stuff. So he just, talks into Dragon, it writes out his comment, and he just clicks publish and off it goes. And it's pretty instantaneous for the private Twitter because I've tested it several times, and I check it every now and then just to make sure that that's working. And it's pretty darn instantaneous to get the notification on Twitter.
Switch back to the market for just a second.
You mean you want to go back to your charts?
Yeah.
Okay.
Give me the screen.
Okay.
Okay, can you see my screen again?
Yes.
Okay, here's what we're talking about, what we're watching. Market's been one time framing from the low. We said that this was a questionable high in B period. We said it's a questionable low in E period. And now we watch the market one time framing, and where are we? We're right back to that B period high that I questioned early in the morning. So, you're keeping an eye on what happens. and it's right back there. So recorded early, we're back. Those things happen. All right. Thank you very much, and I hope to see more of you in our intensive. Thanks.
Thank you, everybody. This recording will be posted. Give me a couple hours to convert it and stick it up on the website. You will find it under public web on our go to resources and then public webinars, and you'll find all of our recordings over there. Thank you very much.